Hello everyone and welcome to this special webinar, Trading the Markets in December, with myself, Craig Erlam, Senior Market Analyst here at OANDA. Today I am joined by the VP of Market Analysis here at OANDA, Dean Popplewell. He's over in Toronto. He is my boss, so I'm going to be very, very polite to him. Dean, do you want to say hello?
Hey, good morning and good afternoon, London.
Thank you very much. Dean, for those of you who don't know, has been here for the vast majority of the time, I think probably that OANDA has existed at this stage. He's also a United fan. That's Manchester United. For those of you who are English football followers, I'm a Liverpool fan. Big rivals, which means we have plenty to discuss when markets are quite slow. It also means that right now I'm extremely smug while he doesn't want to talk much about football at all, if I'm quite honest. So, yeah, today the format is it's going to be a bit different to what we normally do. For one, we're going to be taking a look at the events of the month ahead. There's plenty to talk about, both from a political standpoint, but also a data standpoint. So things like a US jobs report on Friday, for example, being one of these. Dean, obviously being over in Toronto, will have many different views or perspectives on what we're talking about today, which is one of the benefits of these. And if you all find this useful, and it would be great to continue these in the future. We've got analysts across the globe at this stage who, again, will be able to offer their own perspectives. So hopefully this can become a more regular thing. From a technical standpoint, this is the first time we've done one of these webinars together. So hopefully the issues will remain at a minimum. But if you do have any problems, if you do lose sound or anything like that, then please let us know. And finally, this is meant to be an interactive session. We want you guys to get the most out of this that you possibly can. So any questions that you have, just send them through. I'll try and make a note of them. And then for the last 10 or 15 minutes of the session, we will look to answer as many questions as we possibly can. So please do not hold back. Send us through any questions you have, any charts you want us to look at, any topics you want us to discuss, and we will do our very best to accommodate. So on that note, I think we will crack on. We've got a number of topics to discuss. I think if you're interested, Dean, shall we start with the US? We've got the Federal Reserve meeting this month. We've also got the US jobs report on Friday. Today it's particularly interesting because we've also seen that the US yield curve has become slightly inverted between the 2 and 5 years, and it seems to have shaken people up with from a market's perspective. What's your thoughts on everything that's happening at the moment?
Well, I think what we've seen overnight and the market's interpretation of what occurred at the weekend of the G20 between China and US is now become very questionable. And we've seen equity markets definitely give up a lot of their yesterday's gains. And the US dollar certainly has come under significant pressure, as you quite rightly said, that yield curves, the big story on the street at the moment is the inverted between 3s and 5s, and people's interpretation on what the Fed is going to be doing further out the curve. We are now starting to question whether the US will start cutting rates further down the line, and whether the US will push into a recession. So there's been some very big questions being asked over the last 24 hours. And the month that it is, December, which is always an extremely tricky month to trade, as it basically only ends up being about 2 weeks of trading due to the liquidity constraints. So people will also be looking at Powell and the Fed, obviously, especially after his remarks last week, which were certainly more dovish than the market had anticipated. And also this week as well, we'll be looking at OPEC and see what actually transpires, or if anything transpires, on Thursday.
Yeah, you raised a couple of really interesting points there, actually. For one, about the inverted yield curve, the fact that for those of you who don't follow the yield curve moves, basically when the yield curve flattens, it suggests to people that we're not going to see many rate hikes beyond the short-term horizon. When it goes inverted, that effectively factors in people anticipating interest rate cuts further down the line. So naturally, this has led people to associate yield curve inversion with recession risk. Now, I always think this is something that's quite overhyped, the idea that the yield curve becoming slightly inverted, maybe a 1 or 2 rate hikes being priced in suddenly means a recession. And all of a sudden, that seems to be exactly what we're talking about today. And I think that's probably led to some of the risk aversion that we're seeing today. Dean, how much do you buy into this whole idea that all of a sudden, just because a yield curve becomes slightly inverted, that we're talking about threats of recession?
Well, it's an interesting question, and it's an interesting point to look at. Historically, we should be looking at 2s, 10s, 3s, 5s is basically too narrow a window. But if you look at the 3s, 5s, you could actually interpret it as people offloading the shorter asset, so the 3 years, which pushes yields back, and investing in equity markets. Where you look at the 5s, you can also interpret it that's just basically underperforming. Realistically, to really gauge how much rates will move, you should be looking at the 2s, 10s curve rather than the 3s, 5s.
So on that note, how do you think the Fed's going to be looking at this? They seem to be more than happy to look through the market volatility of the last couple of months. And I know people are naturally looking at Fed Powell's comments recently, and they're going to be saying, well, actually, you've actually changed your tone over the last couple of months, possibly under pressure from President Trump, his criticism of the Federal Reserve, the fact that they are raising interest rates, despite the fact that the data has been solid, the economy is booming, the inflation data very much supports it. And yet you've changed tact. So people will say, well, this is clearly a sign that you are under pressure. The fact that you are now saying we're near the neutral rate rather than far away from it, it suggests that you do pay close attention to the markets. Do you think that the Fed's going to look at the inverted yield curve now and use this as a reason to take a step back next year? I think you're probably in agreement with myself that the Fed is raising rates in December, irrespective of everything that's happened. What do you think it means for next year? Is the Fed going to be worried about the inversion?
Not just yet. I don't think so. We, as you quite rightly say, the market's pricing in above 80% that the Fed will hike this month. But looking at the dot plot, people were, prior to this month, people were anticipating 3 to 4 hikes next year. Well, that's certainly now questionable. The quarter over quarter hiking, which has materialized over the past 18 months or so, is not as clear going forward. I think certainly Powell is under pressure politically to a certain extent. But what we now have to do is basically every piece of data becomes that more important. And obviously the US dollar will become hypersensitive to each economic data release as we go forward.
Yeah, I think I agree. We've seen before that when there's a distortion between what the markets are pricing in versus what the Fed has been saying, and the dot plots in particular are showing, you can see a lot of volatility generated around these events, because it seems to take the smallest shifts to change people's views, and also to get people really focusing on the tiny details in the Fed language. And that's something we've kind of lacked over the last 18 months, because the Fed's been so transparent, the market's been really aligned with what the central bank is doing, almost in agreement with what they're doing. But now that we're kind of seeing the same problems that we saw in the early days of the tightening cycle, because we're now at the other end of this spectrum, we're actually so close to the neutral rate, or what people believe to be roughly the neutral rate at around 3.5% now, that we're in a position where every single rate hike suddenly matters again. Whereas in the last 12 months or so, that hasn't been the case. So taking from that, we've got the jobs report on Friday. It's arguably the most followed, tracked, volatile economic release we get each month because of the implications within it. You get an idea of unemployment. We get to see what job creation is like, the earnings figure, which feeds into inflation, participation. There's so many aspects of this report which people pay attention to, and it seems like the thing that's in vogue right now is that hourly earnings rate, because of what impact that can have on inflation, because the Phillips curve seems to have become less reliable, so the unemployment rate doesn't necessarily give us the same indication. Do you think we'll see a lot of volatility this Friday? Do you think it'll play into it, maybe, that we've got this now effective bank holiday on Wednesday, due to the observance of this holiday following the death of former President Bush? Does that have a factor on what liquidity is going to be like, or are we just expecting a normal jobs report with the normal levels of volatility? And what are you looking for from this data?
To be honest with you, we have a much bigger event the day before, which is OPEC. If we don't get a consensus cut from OPEC, that we'll see some extreme volatility. At the moment, the market is pricing in a cut of 1 million to 1.3 million barrels per day, and they are questioning Russia, who is willing to cut about 180,000 barrels. But actually, Saudi Arabia certainly wants more. And commodity prices obviously have a big impact on inflation, and inflation to a certain extent has been kept in check kept in check over the last quarter or so, and that will also feed into Friday's non-farm payrolls. I do not expect to see much of a price increase there, and I expect the number to be very much in line, the trend, and the unemployment rate to remain as is at 3.7%. But I think definitely as we go deeper into the month, liquidity certainly becomes a major issue, but not just yet. I think Friday's number is going to be very important. Any miss will be certainly lead to extreme volatility.
Yeah, I'm inclined to agree. As you said earlier, that not necessarily affecting this month's rate hike, but I think everyone's kind of accepted that that's going to happen, and now it's more a case of what are these economic projections going to say. I think for many people are expecting lower growth next year, just simply because we're going to see the fading impact of the stimulus from tax reforms.
Yeah.
But when you're factoring that in, what does that mean for interest rates? And if we start to see the economy deteriorate prior to the year end, then that could be a sign that the economy is just literally slowing down in line with the rest of the global economy. Perhaps this early trade war, even if it is on pause now, is having maybe a bit of an effect back at home. So I think that is certainly going to be a key factor for the Federal Reserve to watch. Now, before we move on to the oil side of things, because I know we were going to talk about OPEC as well, and we can have a look at a couple of oil charts. On the US dollar front, it is quite interesting, because take the euro dollar chart, which we've got on the screen right now, which I think everyone should be able to see. But anyone who's listened to the previous webinars, which I've been doing the weekly webinars, I'm very much in the camp that I think the US dollar is probably going to be in for a bit of a rough few months. The reason being necessarily just the softer data in the US, which I think we are starting to see signs of, and we've seen it across the year really in things like the housing market already, but also the fact that we are going to start to see softer commentary, more dovish commentary from the central bank, which could potentially feed into a weaker dollar still. But I also as well believe that when we're looking at other currencies on topics we'll talk on soon, I think the resolution of certain things or positive steps on certain things, we've already seen, for example, with Italy and Europe, Brexit situation and others, I think that feeds into other currencies just outperforming the dollar. And we can look at the chart here. I highlighted the potential for this kind of inverse head and shoulders here, which is continuing to form nicely with the neckline around these kind of 114.50 levels. If we can pierce through them, then that could be a nice little bullish signal. But we do seem to have lost downside momentum in this, and this is a prevalent thing across many different US dollar currency pairs. It seems that whether we're looking at the Australian dollar, US dollar, the dollar CAD, dollar yen, the sterling dollar, maybe less so sterling dollar because of the Brexit impacts. But we are seeing signs of a weakening dollar bullish trend. What's your view on that, Dean? Are you in agreement, or are you still the eternal bull?
No, I agree very much with you. I have been negative on the US dollar since the summer, quite honestly. I did expect the dollar to underperform a wee bit more. Hasn't materialized, but I do now feel that we're starting to see it turn over, despite what political risks or event risks that different regions are currently going through. In Europe, you have Italy, you obviously have Brexit, you have political problems in France, obviously with the tax implications. Actually, on that note, Europe, President Macron has basically suspended hiking taxes for 6 months. So that's an interesting development there. Against some of the other commodity pairs, Canada and Aussie. By the way, Australia, the Reserve Bank of Australia, monetary policy meeting was last night, and they, as expected, held rates steady, and does project that economic growth will be about 3.5% over the next couple of years. In Canada, we've got the Bank of Canada tomorrow. A month ago, I would have said that the Bank of Canada would hike. They would go ahead of the Fed. I'm not too sure now. I actually think that they will give the market a heads up for a rate hike in January, just like they did last year, and which should provide some support for the loonie. Seeing it up at around 133 last week was a bit of an eye-opener to quite a few people, and the Canada Bulls certainly came in over the last 24 hours and have been happily adding to their long Canada positions on any dollar uptick. So yeah, we have quite a bit to get through on that. And I agree with you on the euro and dollar yen. The yen pair and the euro itself, I think they will be better bid. I think the dollar will be in trouble, mostly on interest rate. And it's been a one-way trade for such a long time. I do expect and anticipate that people will start to take some profit on that as well.
Yeah, it's interesting. You raised a number of interesting points there. The commodity currencies, which is often associated with risk, have performed really well against the US dollar recently. You can looking at the Aussie dollar and New Zealand dollar again, two favourites of mine, which people will have seen in the other webinars that we do. They've been in such a long-term downtrend, and we did break high when we had some lovely little technical signals here, moving into this kind of 75 region for the Australian dollar, which I think is a real key test for the pair, and it's also a test of risk appetite as well. We've this was such a long-term trend that it really took its time breaking out. There was a lot of caution, but once we saw that breakout, it's been a lovely little trend here, more so actually in the Kiwi dollar. And again, I do think this is more a reflection of risk appetite in general and people's view on the dollar more so than the Australian and the Kiwi currencies, because these are two of the more stagnant central banks, particularly on the Australian front, as you highlighted overnight. The Australian central bank very much seems to be in wait and see mode, most likely until 2020. We've seen a very aggressive breakout here in the Kiwi dollar. Really, it outperformed the Australian dollar even. We came up these 70 levels. It looked as though they were going to be a real test here, but we're not really lacking too much momentum at this stage, and we really are just pushing on. It's been a very aggressive move since the breakout back at the start of November. I've been really pleased with the way that one's played out. You also mentioned a Canadian dollar. It seems like we're summing up a lot of central bank action in one go here, but there's certain central banks which are going to be very active this month, and you're focusing mainly on the Federal Reserve and the ECB, a lot of attention being paid. But there are those that are less active, and therefore it's more of a dollar-driven move, and that's where we're talking about the RBA, the RBNZ, the Bank of Japan being just a few. The Canadian Central Bank, again, is another interesting one, as Dean's just alluded to at times earlier on in the year, towards the middle of the year, even a few months ago. It looked as though some of these rate hikes were almost a cert, and then we look at it now. And I think earlier on this morning, the Canadian Central Bank was priced in at around a 5% chance of a rate hike. So people really not convinced this month. And yet we have finally seen that breakout, which we've been waiting for. Only a minor breakout. I'm not reading too heavily into this, but we've fallen short of the previous high, and we've broken through that trend line. So potentially a nice little bearish signal here for the Canadian dollar in the near term. And again, a reflection of the softening appetite towards the US dollar. And while we're on the US dollar, we'll just highlight the dollar yen as well, as we've just mentioned. It is softening. And for those of you who use Ichimoku clouds, they always look more complicated than they are, but in reality, they're actually just bullish and bearish signals providers. And while it looks complicated, the cloud in itself, I use moving averages as well. I use Fibonacci moving averages. It's just something I've used for a long time, which I like. 55, 89, and then 200, 233. Treat them more as bands in a similar way to the cloud functions on an Ichimoku. And you can see that here the 55.89 coincides quite nicely with the cloud, and price has really tracked both of these higher for quite a while now. We're heading back towards the early part, towards the early to middle of the year. And you looking at this 112 level, and I'm just thinking that this looks really important. If we can break through that, we've broken the series of higher highs and higher lows. Sorry, we're already at a point now where we've failed to make a high on the last two occasions, which is potentially a weakening sign. And we've seen a nice strong sell-off today. Again, in conjunction with the yield, that inverted yield curve, the impact that that's had on the US dollar. US 10-year treasuries are trading much lower now, well below the 3% point. And when you consider that after Powell's comments, we were at 3.25. I think I checked earlier, we were around the 2.75, 2.8 mark. So they've come off quite a bit on the recent Powell comments, combined now with that yield curve move. So I think if we break 112, that could be quite a bearish signal here. And again, if that breaks at the same time as the lagging line takes the Ichimoku cloud as well, I think that could be quite a bearish signal here. The other thing, when people are talking about the dollar as well, before we actually get to oil, which is another really interesting one, as Dean's alluded to earlier, the impact that has on gold is quite significant, because gold has a few different key important drivers. One, interest rates in the US, and the reason why that is primarily is because that tends to what impact that has on the US dollar. It's also a traditional safe haven, so in times of significant risk aversion, that can often benefit gold. Although, as we've seen recently, that relationship isn't always perfect, because we've seen risk aversion related to trade wars, which has benefited the dollar. And because gold is priced in dollars, that's actually had a negative impact. Simple reason being that if the value of the dollar is rising, then that makes purchase of gold more expensive for non-dollar buyers. So you tend to see the dollar relationship, in my view, tends to be the strongest with gold. And that's why, in the near term at least, with risk appetite potentially returning, which I think it will, and the dollar softening during that period, which again I think it will. I think this is really, I think it's going to be the dollar factor that's going to be the driver in gold here. So we're actually going to be seeing, in my view, one of these occasions where at least into 1260 we could see the gold rallying in conjunction with an actual return of risk appetite. What do you think, Dean?
Yes, I do. You actually laid it out very clearly. As I said earlier, I think the dollar.
Not actually surprised.
As I said earlier, I do believe the dollar is about to turn over, and in the month of December is such a difficult month to actually trade. More so with regards to liquidity, that we will see some rather unusual moves. When I was on the trading desk, I used to hate the last 2 weeks trading dollar Canada or anything, any of the other majors, because the liquidity was so poor that we were really always chasing the markets, which makes it for a fascinating time. It's, for some people, it's a difficult month. They basically shut up shop and leave, and for others, some people trade rather aggressively in December, loving the liquid volatility. I do agree with you. I think risk appetite will improve. I do see the dollar underperforming. It's been a one-way trade for such a long time. And I think that the Fed will as we've already seen, he's surprised everybody, being slightly more dovish than we had anticipated. So I think that definitely the dollar will be under pressure. One of my biggest concerns, obviously, is China. What transpired on the weekend in the G20 meeting, we still lack so much details, and the market needs clarity. And hence why we've seen some big moves overnight, especially in equities. And obviously, the dollar has underperformed with regards to rates. It hasn't been seen as the safe haven appetite. So I think we could be in for some unusual moves before we actually get into a solid trend.
Yeah, I think that's a really interesting point on the meeting over the weekend. We did see a really positive reaction to that yesterday. This was prior to the yield curve stories, yield curve inversion happening. And we saw equity markets rallying quite strongly on the back of that, because of that return of risk appetite. That's not necessarily a risk factor dissipating per se, but it's a positive step forward, and that's really how the markets took it. But what that did is that actually hurt the dollar quite a bit, because as we alluded to earlier, the dollar has actually been one of the biggest beneficiaries of this trade conflict between the US and pretty much everyone else to this point, because the country runs such a large deficit with these countries. Then the general viewpoint is that everyone loses. That's a general consensus. That's perfectly understandable, but it's a scale of who loses most versus who loses least. And the US is seen as losing least. If you see the trade deficit shrink and you see China's trade surplus shrink at the same time, then you would view that as benefiting the dollar over the yuan. And that's why we've seen the dollar closing in on 7 against the yuan, for example, because people are viewing that this is a sign that the US stands to gain more than the China, not gain in general, but gain more than China in this trade war perspective. And that 7 handle is seen as such a key level. Sometimes there are fundamental reasons behind that. Sometimes it really is just a psychological thing. For me, I wonder how much of this is psychological at this stage. It suddenly became apparent about 2 months ago that 7 was really key. I don't know who decided this. I don't know why. But all of a sudden, the more people talked about the 7 handle being such a breaking point for this, if we break through the 7 handle and all hell could break loose, it becomes this self-fulfilling thing. And this is one of the areas where technical analysis can also be quite interesting, because it's almost like we talk ourselves into certain levels being key so much that they become a key level. And I feel like that's what's going on here. We have pulled back from that 7 handle now in the aftermath of this Trump-Xi meeting. Whether this actually leads to something is almost in the near term irrelevant for me. And from my perspective, what this 3 months does is it buys the US and China breathing space to try and see if they can come to an outline of an agreement on where they want to take trade in the future. So what kind of an impact, what kind of an agreement do they want to come into on an intellectual property? What kind of a deal do they want to, are they eyeing up for technology sharing? What type of deal do they want to come to on opening up Chinese markets? And then obviously there is the actual just trade factor as well. And if they decide that they are roughly aligned in where they want to head, then they may extend the truce by another 3 months, by 12 months even. And they may even look to reverse some of the tariffs which have been already imposed if the talks are really positive. But this is the important first step towards that. It was always unlikely that Trump and Xi were going to come to a broad agreement over one working dinner. So I think this is a really positive step. Naturally, people are skeptical because we've seen these positive steps before, and Trump very quickly gets back on Twitter and lambasts the very people he was recently praising, and seems to take a big step back on the position. So that skepticism is not entirely unfounded. But at the moment, it has seen this pair pull back from that 7 handle. Right now, looking at this, I'm looking at around the kind of 6.8 as being a potential support. And if we can break through there, then we could get some nice positive momentum to the downside. But again, as with all things related to Trump, this can take quite a significant term in a relatively short period of time. And again, before we move on to oil, this probably does take us quite nicely onto the stock markets, onto the indices.
Sorry, Craig, just before you head that way, there's some regarding China, there's some key economic data events this month that we could see an acceleration of monetary policy and possibly more trade and capital market reforms. Circular calendars for tomorrow's CAC and service composite PMI in China. Then there's November CPI on December the 9th, and on December the 13th, in the weekend, we also have Chinese November retail sales, and finishing it off would be manufacturing PMI on December the 30th. So there's quite a bit of data that China needs to get through this month as well, which will be rather interesting and have a big impact on the yuan as well.
Yeah, people very much paying attention to China's response to this. It's been interesting that from a fiscal policy standpoint, the usual response over the last decade to any weakness has actually just been infrastructure spend and investment as a means to try and get the economy generating higher levels of growth again, this kind of short-term gain, while overlooking the potential long-term destabilizing impact. Yeah. Recently, the actual response has actually been more from a tax perspective, so looking to offer tax incentives to try and stimulate the consumer rather than just through building roads, etc. And that's been an interesting change from the Chinese government. So you wonder whether that's going to coincide with a slight shift in monetary stance as well, because we know that they've wanted to avoid monetary loosening in the recent past in order to avoid any long-term negative implications. But at times they've had no choice but to continue along that path. And if anything, they want to try and rein that in. So it's going to be very interesting to see how they actually respond to that over the coming months, unless, of course, the heat is taken off them by some positive trade talks, which has obviously always been the longer-term aim of President Trump.
Exactly.
So, in terms of the stock markets, then, what I found really interesting over the last 24, 48 hours is that while we did see a big rally in the markets, taking this Dow chart as an example, and we have actually seen them bounce back nicely in general, really, since late November, we have once again failed to make pierce that previous high. We've kind of struggled around the 26,000 again, and now we are edging lower on the overnight news. So we've got a series of a couple of lower highs here. That's not the end of the world. It doesn't mean all of a sudden that the bottom's going to fall out of this. But it's something that I'm very much keeping an eye on to see if this is a trend that continues. If every rally we fail to make a new high, then that is a sign of weakness in any market. We saw it developing over around 6 months in the cryptocurrency space with Bitcoin before the bottom fell out a few weeks ago. I'm looking at this right now, and I'm looking at the 24,000 level below and saying, right, this has been a relatively stable holding point for now. But equally, this was at a time when we were holding above the 200, 233 day simple moving averages. That 201 is always one that's held quite closely to people in the equity markets in particular. We've chopped through there a couple of times. This looks to me like a market with weaknesses emerging. I'm a bit nervous about the Dow and the others right now because of this floor we've got, which is holding for now, but the lower highs is a bit of a concern for me. What's your thoughts, Dean?
I agree. And I still think the tech sector is overvalued, and certainly will put pressure on global indices. Obviously, it all comes down to what happens between China and the US. If we don't get any clarity, equities will continue to be under pressure. And that obviously has a knock-on effect to the fixed income and to the dollar itself. So I would be nervous equities at the moment. It's been very difficult being long that market for such a long time. To find good reasons to stay long that market, especially if we're going to start calling economic data into question. I can't stress enough how hypersensitive the US dollar will be to every economic data release, which we haven't witnessed for quite some time. because everything has been the same trajectory. So yes, equities, definitely keep an eye on that one, and I would be wary about the top side.
Yeah, it's always nice as well when we're all these things are coinciding as well. It does give you a bit more confidence, a bit more conviction in your beliefs. That's obviously not to say that the markets are predictable or that our beliefs are correct by any stretch of the imagination. They can always surprise us, and over the course of my market following lifetime, they have done repeatedly. Just every time I feel a bit confident, like I'm starting to really get the grips of it, they throw me a curveball. But the fact that we are looking at potential dollar weakness, softening Fed rhetoric, economic weakness, and we're seeing this build up in the US equity markets as well, which have really outperformed other regions. It does suggest that the markets are building us this kind of scenario here that would suggest the first quarter to the first half of next year may not be as straightforward as this year has been. Let's move on now. We've come close to talking about it repeatedly. We're just over halfway through the webinar, so I don't want to have to rush what I'm sure is everyone's favorite topic right now, which is Brexit. So we will move on to oil markets. It's so interesting right now, oil. I find there's so many different facets to it. There is the games between OPEC and OPEC Plus, as they're now known, and the US and the Trump administration. There is the Iranian sanctions, which was followed after everyone else up their production. We were seeing record output from the US, from Russia and Saudi Arabia, the three world's largest producers. And then they get offered 8 waivers on Iranian sanctions, which caught people off guard, which meant that this market, which was looking roughly in balance, suddenly was looking very oversupplied, because Iran is, I think it's the 3rd largest OPEC producer. On top of that, you've got the Khashoggi killing, which has called into question the relationship between the US and Saudi Arabia, with the US, with Trump appearing to bend over backwards, really, to avoid having to take a firmer line and a firmer position against Saudi Arabia, no matter what stacks up against the Mohammed bin Salman. And on top of that, we have the fact that the inventory numbers are really starting to stack up, which has weighed heavily on oil as well. All of these things have left us in a position whereby we're now looking at this OPEC Plus meeting in 2 days' time, and we're thinking surely a production cut, as you said earlier, between 1 to 1.3 million barrels is almost a guarantee. And then we get thrown some last-minute curveballs again, with the reports today that Russia may not be on board, actually, with a substantial cut, and Saudi Arabia suggesting that if they aren't, unless you're going to be on board with a substantial cut, then there's no point in doing one at all. There's Qatar, who announced only yesterday or the day before that they are leaving the OPEC cartel after 57 years as a member. We've got geopolitical issues there with the embargo led by Saudi Arabia, but also others in the region, UAE, etc., clearly being a factor despite the denial on their part. I mean, how do you piece all this together, Dean? Is this obviously it's good for markets, right? It's good for volatility, and as traders, we love volatility and we love seeing these moves materialize. We don't want a dull market. But how does this help you build a picture in your head of where oil's heading?
That is the million-dollar question. I think the event risk on Thursday is if the size of the cuts may not be clearly announced, and that could be because they want to avoid antagonizing the U.S. And this morning, it's not a surprise that Russia is starting to capitulate and not toe the party line. I think crude certainly has inventory problems, most definitely. And we forgot to mention also that Canada as well, in Alberta, they actually indicated that it would force producers to cut output by 8.7%. So a self-induced sort of tariff there, which also has provided a bid. The US, the shale, they're pumping out so much crude. The US wants lower oil prices. I think we will get lower oil prices. OPEC is not as strong an influence as it has been in past. I think Russia will not come to the table enough for the other OPEC members. And I still think, on Thursday, oil could come under severe pressure. The market certainly has bought back quite a bit of contracts over the last 48 hours or so, but I would be certainly worried about prices going too high at the moment.
I mean, are we not looking at a risk factor here, though, where, yes, we have had a strong bounce back here. We were trading at around a kind of 58s in Brent. $50 is clearly quite a notable line in the sand in WTI. We have seen a nice little bounce back here, but when we compare that to the sell-off that we've seen over the past, really since the start of October, which aligned with the risk-off sentiment in the markets, we can't underplay as well what impact risk, especially economic growth, global economic growth related risk has on Brent crude. Just going back to the very basics of the economics of supply and demand, if we're talking about an economic slowdown over the next 12 months, then that impacts the demand for oil itself. That's a major factor also. We have seen a nice little bounce back over the last couple of days, but is there not a risk that, in fact, even if OPEC does cut production by 1 million barrels a day, that's fully priced in, and then we see a potential short squeeze? Do you think that's a possibility, or do you think we've already kind of front run that?
I think we've already front run that, to be honest with you. Crude prices are a very strong barometer for global growth, and if we are starting to question growth over the next 12 months or so, then you've got to think that crude prices certainly have the capability of going much lower, certainly down to the $40 handle. Unless we get a significant cut, and I mean a significant cut from OPEC, we will certainly see crude trade under pressure again.
Yeah, I think I'm in agreement with you there. It seems that it would be an unusual move for them not to cut, because they know the implications of what they are, what they would be effectively be letting themselves in for. And I almost feel that any decision not to cut or to offer token cut, which would put the market under pressure, it's almost be a sign of them not learning the lessons of the past, when they were slow to respond initially back in 2015, I think it was, and this coordinated effort was almost in the works, but it wasn't really coming to the fore. And oil did fall back to these kind of $40 a barrel levels, and all of a sudden we saw this kind of panic response, because so many countries at this point are unprofitable from a production standpoint, and we started to see that come under great pressure here. I almost feel like we're back at these kind of levels now, where if they get this wrong, it could really come back to haunt them. And the US is in a very strong position now, because its shale industry is extremely competitive. They are producing oil at lower costs than many countries, many other oil producing countries, including a number of OPEC countries as well. They're extremely efficient. They're extremely fast to respond to changing dynamics in terms of the supply and demand side, and therefore they are in a very strong position. So you've almost got this kind of OPEC plus cartel operating to an extent from a position of weakness, and therefore a show of weakness in a couple of days' time, which would suggest that they are bowing to Trump pressure, could really, really damage them.
I totally agree. And the influence of OPEC, and because it takes them so long to come to a consensus, you have to question the value of crude. And everybody's in it for themselves. It's not the cartel of old where the consensus rules. Nowadays, it's a me. And OPEC certainly does not have the same influence as it had a decade ago.
And do you think there's a kind of you scratch my back, I'll scratch your situation?
Oh, most definitely. Yeah. Oh, most definitely. And it's window dressing, to be honest with you. And that's why I would certainly feel rather confident being a crude oil bear.
Yeah, it does seem to have got to the point now where no one's surprised, but everyone's disappointed. We saw this coming such a long time ago. We knew that this was going to be used almost as a cog, and it's playing out unfortunately as many expected it would. It seems to be that, and as Trump's alluded to, perfectly clear, the dollar value is far more important than anything else, and it seems that if we don't see a cut this week, or if we see a token effort, it would certainly be sending the message that we are willing to repay the favor if you just turn a blind eye on this occasion and try and move on without attracting too much attention. So that now finally brings us back to the
Brexit.
most boring subject on the global stage right now, that topic, which is I remember saying back in June of 2016, I was personally of the belief that it wasn't going to happen. I was personally the belief that it wasn't going to get over the line, that the fight may be a bit closer, but I thought there'd be enough on the Remain side to see it through. And I remember saying on June 23rd, June 25th, I can't remember now off the top of my head, the best thing about this evening's result is that I'll never have to say the word Brexit again. Well, how wrong I was. We very much, it's been the constant talking point now ever since. And just as it seems we're reaching the end, it seems like the situation's got more confusing than ever. It doesn't seem clear. We're now at the start of December. It's extremely difficult to predict where we're going to be at the end of this month. It's extremely difficult to predict who the Prime Minister is even going to be at the end of this month. We've now got a situation whereby there's a 5-day debate in Parliament about the elements of the deal that Theresa May's agreed. The backstop issue is extremely controversial because of the potential it has to tie the UK into the customs union indefinitely if it doesn't agree to a trade deal with the EU in the aftermath of the transition, assuming the transition doesn't see a trade deal agreed at all. From my perspective, it strikes me as a very much a trusting approach to take from the UK's perspective, because it effectively gives a lot of the leverage to the EU, because the UK's alternative to accepting the EU's demands in these trade negotiations is to remain in this eternal backstop, which doesn't deliver on the Brexit referendum without the ability to exit it. What's the view from over there, Dean?
Totally confused by the whole situation.
Join the rest of it.
It's been a quagmire trying to fully comprehend exactly what's going to happen. I'm assuming, along with many others, that the Brexit vote will fail on December the 11th, despite all these debate. I don't even know who's going to be ruling the country by the end of this month. So it's a very
exciting time to be a Britain.
The one thing I am nervous about is actually trading sterling and being long sterling. Obviously, good money has been made by being short sterling on the crosses. I mean, even this morning we saw a significant jump, nearly 0.75%. We saw the pound rally after the European Court of Justice Advocate General said that the UK could still cancel Brexit by revoking Article 50 without the consent of other EU member states. That in itself, sterling is very, very sensitive to every headline, every piece of rhetoric, and quite honestly, sitting here in North America, I'm looking at the UK government, and it's just imploding. And quite honestly, I could not tell you where or what shape the government will be in come December the 30th.
Yeah, there's been a constant news flow, particularly over the last couple of months. So trying to stay on top of that has been challenging, even from London, to be quite honest with you. And like you say, sterling's been so volatile and so so sensitive to any Brexit-related news. So take this morning's moves, for example. We saw near on 100 pip move to the upside in pound dollar. It doesn't look like much on this chart, but that's more of a reflection of the chart itself right now and how sensitive the pound is. And this morning's news didn't really strike me as being news per se. It means that the UK can unilaterally, or assuming that this is carried through by the ECJ, which it probably will be, it means the UK could, if it chose to, unilaterally withdraw its Article 50 submission and remain in the EU. Well, I've got news for anyone who is surprised by that. If the UK couldn't unilaterally do it and requested to withdraw Article 50, the rest of the EU would accept that willingly. They don't want us to leave any more than we want to leave. They don't want us to leave any more than Remainers wanted the UK to stay in the first place. That was never the issue, but the pound is extremely sensitive. And again, the example I always use it was a couple of weeks ago. It was when Theresa May had met with the cabinet. She was due to hold the press conference, and the UK police minister was reported to have said that Theresa May would not be holding a press conference anymore. And the pound fell about 100, 150 pips on that news, on this signs that, oh my God, what's happened? Something terrible must have happened. Well, there was a few things. Firstly, I don't think most people knew that there was a police minister in general. And
I never heard of one.
I don't think anyone could name him. And yet this person, reports of what this person is saying is making the pound move so dramatically. And that's really a sign of where we are with the pound right now. So like Dean says, it's one of those currencies right now where you've got to have a lot of guts with that, and you've got to be able to stomach very wide and volatile moves. At the drop of a hat, you've got to expect there's going to be constant news flow, which is going to have significant impacts. From a purely technical standpoint, I always say with these, in these situations, I cannot take the technicals with a pinch of salt because the news flow is so dominant and so frequent. But what Craig, I am seeing right now is...
Sorry, Craig, could you run through quickly sort of the timeline for sterling this month? You've got they're currently debating now, Brexit debates. Then you've got the vote on the 11th. If that fails, what does Theresa May do?
Yeah, so from then on in, you'll effectively see then Theresa May will have to decide what her next move is going to be. Now, that next move could be to go back to the European Union, go back to Brussels and say, look, this vote hasn't passed. We're headed for no deal. You need to give us something to take back to Parliament that I can actually get through. Now, there was a Times report on Friday, and it was about a leaked document, I believe, basically suggesting that one of the final shots that the UK government has held back, which they didn't use prior to this because they didn't want to lose. To kill the negotiations with the EU altogether, was to add in some legal text which said, under these scenarios, if X happens and Y happens and Z happens, then we can withdraw unilaterally from the backstop and exit the EU with this kind of notification period, giving this much time for everyone to adjust, etc. This was their way of saying, look, it's either this or no deal, and a no deal Brexit puts up that border on hard border on Northern Ireland, which you are saying that the backstop is intended to avoid. So you have to negotiate with us because that is the only other alternative we have at this stage. How much of that is true, we haven't heard too much of since. It does sound to me like there is some substance to it, and it does sound to me like a potential route afterwards. Once the deal is rejected, I'm very much with Dean. I think that it is going to be rejected this time next week after this 5 days of debates, because there's just too much opposition to it from within the Conservative Party, from the Labour Party, the DUP, which is in this confidence and supply agreement with the Conservative government at this stage.
Craig, do you think that's close to being priced in?
I think what we're seeing priced in right now, based on recent price action, is people believe that while there is a lot of negative news flow currently, the fact that this 127 level, for example, in cable is holding so well still at this moment in time suggests to me that people think there is going to be a backdoor. There is going to be a way through. Can't necessarily say what it is. And this is where trying to lay out the plan for the next month is so difficult, because it's almost like one of those books that I remember seeing as a kid. It was, here's two options. If you pick this option, go to page 72. If you pick this option, go to page 83. And all of a sudden, the timetable and everything changes, and where you are in the book changes from everywhere thereafter. And I feel like the Brexit situation is very much along this line, because for one, Theresa May could go back to Brussels and they could give her what she wants, and they could come back to a vote in Parliament. That gets passed because the Brexiteers are happy that they're not stuck in an eternal backstop, and that gets through, and we start to make these steps forward potentially in January. If the EU rejects that, then really Theresa May is in a completely untenable position. And if there isn't a confidence vote from within the Conservative Party, there'll certainly be a confidence vote from the opposition benches as well, to try and call for a new election. The campaign for the second referendum, I think, will gather steam, because I think the possibility of a cliff edge no deal Brexit would be devastating for the near term UK economy. That's not to say that in the long term we won't be okay, but for the near term, the impact of a cliff edge no deal Brexit would be quite severe. So I think that's going to be avoided at all costs from both sides. So from there on in, again, there are a multitude of potential options, including a managed no deal Brexit. So this is would effectively be where we have a no deal transition period. So maybe not lasting 21 months, maybe lasting 21 months, that enables structures to be put in place to deal with what a no deal Brexit would be. That would vastly reduce the negative impact from an economic standpoint of that no deal Brexit. And I think there is an incentive in the EU to do that. For one, the UK financial services sector is so ingrained within the EU economy that cutting off businesses' access to that sector, from whether you're talking the derivatives market, whether you're looking at the insurance market or anything else, would be extreme, and that they do not want to self-harm in such a way. The other thing as well is around more than 50% of Irish traders with the UK. So if you start putting up barriers there and you start putting up checks and blockages, then that's going to have severe impact for the Irish economy as well. And there's other economies which are deeply ingrained within the UK trade as well. I think Netherlands is another example of that. So I think there's incentives on both sides to avoid that. Is
there a possibility that there could be another Brexit referendum?
I would say there is a possibility, but there are a number of steps which would have to be undergone first before we reach that point. And for me, I don't think it is a good alternative. I would much rather see as a last, I would much rather see, for example, Theresa May removed and replaced with a Brexiteer who can then go and try and renegotiate the parts of the deal that they disagree with and try and receive a better deal. Because one of the issues that we've had all along so far, and it's the issue that we've got with the second referendum as well, is that Brexiteers who campaigned for this vote and who campaigned to get it over the line had all envisaged a different Brexit than what Theresa May, or claimed to have campaigned on a different Brexit than what Theresa May has been able to deliver. So if you put this on a ballot paper and you say the options are Remain, no deal, or Theresa May's Brexit deal, then they will say there is nothing on there that represents what we campaigned for in 2016. So from my perspective, that's why a second referendum just doesn't answer the question, because if then people then say Remain, then the same people who campaigned 2 years ago will start campaigning again and say, well, if you can have a second referendum, we can have a third based on what we promise. So my preferred option in this situation, if Theresa May's deal is an absolute non-starter, then for me, I would rather see a Brexiteer replace Theresa May and lead fresh negotiations. And then if they can't get anything back from Brussels, then that would just go to show that what they campaigned on 2 years ago was not possible, and that then you can have a fair and real second referendum, because you can say, here's what they promised, but here's what they could deliver, the Brexiteers. Here's what Theresa May achieved. Here is what you can Remain, or you can do no deal. And then you've got to, and I know that sounds complicated, and I know it sounds a bit overstretched, but you could treat it like the political system that many countries, I think France included, have, where you could have 2 rounds of voting, where you put a vote out and you have you take the 2 most favoured options, and then you take that to a final vote. I think that's the only way you could possibly have a second referendum, because for every reason that I've just said. But I think we're a long way away from that, and I still don't see that as being a likely outcome. But there are so many outcomes, and that's what's going to make the pound so volatile between now and probably at least the end of the year, but potentially beyond again. And with that, that takes us to the end of the webinar itself. If there's any questions, please do send them through. But if not, we will wrap up there. It's been we've had the full hour now so I'm very keen not to waste anyone else's time. I've tried to cover a variety of topics and a variety of charts with you all, so I hope that you're all satisfied with that. While we're waiting for any questions, if there are any to come through, if you want to hear more about what we do, then visit the OANDA MarketPulse website. That's marketpulse.com. That's where you'll see all of the data that all of the analysis which myself, Dean, and the other analysts here produce on a daily basis. So please do check that out there. Again, covering a wide variety of instruments. We also have 2 podcasts out there now. There's my own, which is the OANDA Market Insights podcast, which I do with record every Friday with Jazz FM. And we have regular guests on there, be that Dean or Alfonso or Steve, or actually Dean's yet to join me, but after today's performance, I'll be getting him on in no time. Then there's Alfonso, does a podcast which he releases, I think, every Wednesday. That's OANDA Market Beat, covering a variety of topics as well. And then the recordings of these webinars as well can also be found on the OANDA MarketPulse website again, but also on YouTube, and we also tweet them out as well. If you want to follow us on Twitter, you can. There's @marketpulse.com is the MarketPulse Twitter handle. There's myself, which is Craig_Forex, and Dean.
Dean_Forex.
Dean_Forex. So follow him. Ask him as many questions as you can possibly fathom up. I implore you to really, really pester him. Ask him loads and loads of questions. Don't worry how difficult it is. He's an incredibly smart man. I'm sure he'll be able to answer them all and quickly. But apart from that, yeah, I mean, we've had no questions. So hopefully that means that we've covered it all and not that everyone's fallen asleep. Do join us again. Next week, we've got a normal webinar again. I think actually I might be joined by our new analyst over in New York, Ed. So hopefully we'll be able to find you'll get some enjoyment out of that as well. But hopefully we'll look to make these a monthly occurrence where we take a look at the month ahead, myself and Dean, or myself and someone else, and we can gather as much as this as possible. But thank you all very much for joining us. I hope you have a fantastic time. I hope you have a fantastic month of trading. Thank you, Dean, as well for joining us.
Thanks, Greg.
We will catch you all again, hopefully very soon. All the very best luck with your trading. Great end to the year, and I wish you all the very best. See you soon.